Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. Welcome to our monthly market update. For this month, we're going to take a look back at not only December, but all of 2016 and review our outlook for the year to come. December's roughly 2% rally brought to an end an eventful 2016. The year brought us a number of notable storylines and surprises, including the worst start to a year ever for the stock market, oil prices plummeting to the mid-20s, the surprise Brexit vote, and a Trump victory in the U.S. presidential election. Yet, with that backdrop, we saw the S&P 500 rally just under 10% for the year and upwards of 22% from the lows in February. Stocks weren't the only investment to experience ups and downs in 2016. It was quite a roller coaster for bonds as well. The U.S. 10-year Treasury yield started the year off around 2.3% before dropping as the market sold off and fear of slow global growth took hold. As the year progressed, fear around the Brexit vote may have led investors to seek safety and buy bonds as yields went lower. Bond yields then rallied post-election as markets appeared to price in growth and inflation as Trump's proposed plans include infrastructure spending, tax cuts, and potential deregulation, which historically favor growth, potentially leading to increased inflation. As President-elect Trump begins his first term in January, we believe politics will continue to be in focus for 2017. Going into the November election, there was concern over the potential market reaction to a Trump victory. Thus far, reaction in stocks has been positive, as Trump's post-election rhetoric has generally been seen as supportive to U.S. economic growth. While the market has viewed this positively, a Trump presidency brings with it uncertainty. We wouldn't be surprised to see market volatility driven by politics, as potential policy changes or lack thereof could surprise markets. Political risk isn't limited to the U.S., as Europe has a number of votes throughout the year, which could shape the future direction of the European Union. These include elections in France, Germany, and potentially early elections in Italy. Combine this with the ongoing Brexit negotiations, and 2017 is likely to be a pivotal year in understanding what the EU will look like moving forward. As always, we'll keep a close eye on the domestic and foreign political landscape and make tweaks to the portfolio as needed. Positioning portfolios during times of political uncertainty can be a challenge as political risk comes and goes. Looking at the fundamental economic backdrop will hopefully give us a clearer picture of the year to come. As we look at the U.S. economic data, we're encouraged. We don't see a recession on the near-term horizon. Our economic dashboard is once again showing few reasons for concern as we see stabilization or improvement in a number of elements, including sentiment, leading economic indicators, manufacturing activity, and a steepening yield curve. The only element of our dashboard that gives us reason for some concern is equity valuations, meaning that the U.S. stock market may appear expensive. While valuations can give us guidance as to the general value or lack thereof in the stock market, it's generally not a good short-term market indicator. As we look outside of the U.S., we're encouraged at the potential for growth as a number of key economic indicators have shown improvement, and the IMF recently upgraded their outlook for projected global growth to 3.4% in 2017. We're cautiously optimistic as there are a number of potential headwinds to be wary of, including political change in Europe and threats to global trade given increased protectionist rhetoric and currency volatility. A big question is, how will global growth impact earnings? In the U.S., the corporate earnings recession appeared to come to an end during the third quarter of 2016, as we saw positive earnings growth for the first time in a few years. Earnings growth appears poised to continue, with projections of 11.5% growth for the S&P 500 in 2017, according to FactSet. This double-digit earnings growth has been priced in for a few months, and there's potential for surprises, depending on the impact of policy changes such as corporate tax cuts, deregulation, and repatriation. Much time has been spent analyzing the potential impact of rate hikes by the Federal Reserve, especially as we've seen expectations for inflation rise in recent months. In December, the Fed hiked rates for the first time in a year and set expectations for 2 to 3 rate hikes in 2017. It's our belief that the Fed will continue to be data dependent as they look to gradually raise rates, and that the path and pace of rate hikes should be watched closely. While any surprise changes from the Fed will warrant close analysis, we don't feel that the current rising interest rate environment poses a huge threat to the U.S. economy, at least over the next 6 to 12 months. We believe the risk of recession is relatively low, and as such, we want to be fully invested in our equity portfolios. While we see some additional political risks internationally, compelling valuations in developed and emerging foreign markets lead us to maintain both U.S. and international exposure, as we expect to see moderate returns for stocks. While we have reason for optimism moving into 2017, there is no shortage of potential risk factors to keep a close eye on. These include the aforementioned political risk, currency fluctuation, oil prices, the risk growing protectionist policies around the world pose to global growth, and any big surprises from central banks. The unknown unknowns, as they've been called, make forecasting economic and market returns an imperfect science. But it also highlights the importance of having an active strategy in place. We believe an investment strategy that gives flexibility to adjust portfolio allocation amidst changes in ever-evolving economic and market environments is critical. At Texas Legacy Wealth Management, we're constantly looking at a wide variety of economic and market data in an effort to best position your portfolio for the market conditions and determine whether it's better to be fully invested or to be more defensively allocated. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We'd also like to remind you to follow us on Twitter and like us on Facebook.